Kia ora koutou katoa, no mai haere mai ki te putia mātua, no mai haere mai ki te hui tēnei rā. Tēnā koutou, tēnā tātou katoa. So good afternoon, welcome to the Reserve Bank and welcome to this hui on our financial stability report, this document here. As always, joined by key colleagues on the stage, a couple of familiar faces to you by now, Jess Rowe, Director of Prudential Policy, and Chris McDonald, Manager of Financial System Monitoring and Analysis. Financial stability is crucial for New Zealanders to have the confidence to safely save, borrow, invest and manage risk. Our assessment is that risks to the financial system have increased. Geopolitical risks highlighted in our previous report have escalated. Market volatility has increased. Financial market functioning has been strained at times. And there is still considerable uncertainty about how this all plays out, including the impact on the global environment and here in New Zealand. Domestically, economic conditions remain subdued. A weak housing market and a weak labour market have weighed on demand. However, lower interest rates and high agricultural export prices have supported debt serviceability. Importantly, our banking system remains resilient with strong capital and liquidity buffers, meaning that it is well placed to face these risks, not only these risks, but others. Continuing to support the economy through providing credit even if conditions deteriorate from here. In the general insurance sector, conditions have, the environment has been more supportive. Our recent general insurance stress testing exercise highlighted the improved resilience of the sector, although it did highlight a number of challenges of an extreme seismic event. Work around our Deposit Taker Act implementation continues at pace, including promoting competition and efficiency. You would have seen from the report that the work for our review of key capital settings in the banking sector is already underway. We've shared the terms of reference in the report, and you'll see that it is wide-ranging with a number of avenues for input through analysis already undertaken through previous inquiries and reports, a channel for consultation, and key input from global independent experts to input and challenge into that report. Finally, the Deposit Compensation Scheme goes live on the 1st of July this year, and that is a key milestone for us when it comes to implementing the Deposit Taker Act and supporting trust and confidence in the sector. I'll open it up to questions now. Just a little reminder that we are here to talk about the Financial Stability Report. By its very nature, it's focused on the risks, vulnerabilities and some of the downside scenarios out there. I'll be back again in a couple of weeks with colleagues to talk about the monetary policy statement, which is our central view for the economy, looking forward and what that means for interest rates. As always, if you direct questions through to me, I can share them out amongst the team as appropriate. Kia ora. We'll open it up.
You talk about insurance and the increase of risk-based insuring. How much of a risk is it that we're going to start to see housing that isn't insured? Because we can't get insured, it's so much more expensive than down the road.
So that's something that we've outlined in our previous report, the increase in risk-based insurance. We've identified that on net, we think that that's a good thing, that insurance is risk-based. It's important that people get the right signals about the risks that they face and the incentives that creates around the choices that they make. We've also identified that while it's a good thing in aggregate, it will potentially create issues around availability, and we are monitoring the availability of insurance, particularly for mortgage holders. At the moment, there are only very small pockets that are uninsured or have a very limited number of options in terms of pricing for insurance.
So there are now places that are uninsured.
Chris, do you want to talk about the data? I know it's not covered in this report, but it is. We've highlighted it in previous reports.
Yeah, so 12 months ago we put out a special topic that looked at the affordability of insurance, for property insurance in particular. And one of the data sources was some material that Treasury had put out, and it was looking at the number of online quotes available for different suburbs. And what it found is that very, very few of suburbs across the country, almost none, but very, very few, had no online quotes available. So there were online quotes available for almost all suburbs, basically.
Kia ora, thanks for having us. Dan Brunskill from Interest.co.nz. I'm interested, the report talks about risks having increased. I know everything is relative, but in the scenario that we talk about is sort of a slowdown in global economic growth, not a recession or a crisis or anything. Is it really fair to describe a slowdown in economic growth as a risk to New Zealand's financial stability? How is that really a risk to stability?
I think where we came to that assessment is through the analysis that we shared last time around about geopolitical risks and just the number of different channels that affects our economy and our financial system, particularly through the functioning of markets, the availability of credit, the channels through to the economy in terms of not only the direct channels in terms of how tariff barriers can affect local industries, but more importantly, those indirect channels around how a global slowdown will affect us in aggregate across the economy. Since our last report, we've had the Liberation Day speech on the White House lawn, and that looked like a quite extreme scenario in terms of how a trade war or geopolitical event might play out. Since then, we've had an evolution of those tariffs, and things have changed. So a less extreme scenario as currently stands, but there's still a considerable amount of uncertainty about how that plays out and where those tariffs end up as the dust settles. That will impact on global demand, but there are also some really big questions around just the whole structural makeup of the global economy, about how different supply chains could get disrupted, how different industries could get disrupted. And when we look at it on that broader basis, we think it's fair and prudent to make that assessment that those risks have increased, and we still need to be very wary of them.
And just a follow-up question, or a second question, I guess. There was mention in there around the seismic event scenario and requiring some impact on the Crown balance sheet to help cover those costs. And it says being able to manage those shocks is the key consideration in the government's fiscal strategy, which Treasury is consulting on. In your view, does the central government currently have sufficient room on the balance sheet to cope with that kind of seismic risk that you've talked about in this report?
Yeah, so thanks for bringing the stress test up. It's an evolution in our stress testing program that's evolved through time, one that started out stress testing the banking industry to macroeconomic shocks. We've moved on to stress testing the banking and insurance industry to different climate scenarios, and now looking at the general insurance industry for a seismic event. The size of that stress was deliberately large. It's the nature of a stress test, so it was larger than the probability of a seismic event in terms of how we set capital for the industry. So we did want to see how that would play out and how how resilient the industry would be to that. It's a good news story in the sense of it is an industry that would be able to pay out on claims and meet those claims of customers, which is really important in that type of scenario. But it does raise questions about the go forward in terms of how they recapitalise, how these other players in the picture, including the National Hazards Commission and the Crown, come to the party and bear that cost. There's been long-standing advice from the Treasury itself around one of the reasons in New Zealand that we need to have a relatively lower level of government debt to GDP than other countries is because we are exposed to these types of events as a country, and so that's something that's very sort of long-standing in terms of that advice and something that has driven the fiscal strategy going forward.
Hi, Jenny Ruth from Good Returns and Just the Business. On page 8 of the report, you say that the effective weighted average mortgage rate across all borrowers remains close to its peak. So has the 2 percentage point cut in the OCR not been, are you saying it's not been feeding through into mortgage rates?
So it's a good one for Chris talking through our data sources and how to interpret that information.
Yeah, so the effective mortgage rate that we're referring to is essentially the average across all of the mortgage lending that the banks do. So that peaked last year at 6.4%. And as mortgages have repriced onto the lower mortgage rates that we've seen more recently, we've seen that come down to 6.2% currently. So it's actually still pretty close to that 6.4%. We do expect that that will continue to drop, and that's as mortgages kind of reprice onto the current relatively low mortgage rates. So you can, if you look into the market right now, the 1 and 2 year rates, you can get around 5%. So you would expect the average mortgage rate over the coming 12 months to start to head down into the fives, I suppose.
Also on page 7, you say that house prices remain around the top of our range of sustainable house price estimates. So you're basically saying they're only just at sustainable levels still?
That's right. We publish a range of different measures from a financial stability point of view. We're looking at how stretched the housing market looks relative to those sustainable measures. House prices have come back over recent years towards a more sustainable level, but are broadly at the top end of that range. So it's not a large issue from a financial stability perspective, but from a general economic outlook, it's one where house prices are likely to be subdued going forward. Just coming back to Chris's previous answer about the interest rates and the transmission lag and the time it takes for changes in the official cash rate to work through to other interest rates and ultimately the economy, that transmission channel is one of the reasons that we see that even though economic activity is relatively subdued at the moment, as we look forward, those lower effective interest rates coming into play added into with high agricultural export prices at the moment provide some support for the economy going forward.
Hi, Dan from Interest again. I see you going ahead with the capital requirements review.
Yep.
We were interested in the office as whether you see any possibility that review will not result in some kind of lowering or softening of the rules.
So we've committed to reviewing the key capital prudential requirements. We haven't committed to any particular outcome from that review, so it is a review that we go into very open-minded and one where we want to draw on the evidence, both of the Commerce Commission's market study and then the Finance and Expenditure Committee's inquiry, the analysis and other forms of evidence that we've had since then. We've already got a number of aspects of our capital regime under review, and this just becomes a really good opportunity for us to bring that all together, take that all at once, and come out with a recommendation and a landing place that we can then implement as part of the Deposit Taker Act. I'm going to bring in Jess here because I've been eager to bring in Jess in this. Jess is leading the team on this review and can give us a bit more flavour as well.
Yeah, we've undertaken a number of consultations over the last few years as well on the overall capital settings. We've sourced additional information on granularity of our risk weights. We've also been out consulting on our crisis management framework, including looking at the types of capital instruments that you might want to employ to support our new crisis management framework under the Deposit Takers Act. So there are a range of kind of components of the regime already in play, and bringing all those together as well as, you know, additional evidence and data since the original review, it's a really good time to kind of put that all together. As Christian says, we are really focused on making it kind of short and sharp but robust, because we want to be able to implement the Deposit Takers Act within the time frame that we've committed to.
So we shouldn't see the review as being a sort of admission that the critics are correct and that capital requirements are too high, which is how some people are interpreting it.
It's a conclusion from us that now's a good time to look at the settings as we go into implementing the Deposit Taker Act. Our initial view had been that given the size of the implementation required under the Deposit Taker Act, bringing together the banking system framework and the non-bank deposit taker framework into an overarching set of standards, just the practical implications of that was our first intention was to lift and shift as much as possible as we could from the existing regime and bring it into that format. As we've had these other inquiries and studies, and as we've re-looked at evidence, and as we've committed to undertake reviewing various different subcomponents of capital, it just made sense to bring that all together.
And I guess, were you surprised or even disappointed even that the banking inquiry, which was originally pitched about scrutinising competition, ended up kind of pivoting into an inquiry into the Reserve Bank's capital requirements? Were you surprised or even disappointed by that?
Just like any other party we engaged in that process, we had our opportunity to provide evidence and give the context that we can give. Our review, there's some things in that inquiry that are very insightful and are key bits of evidence and material that will go into our review. There were other things said at that inquiry that weren't substantiated and they can be scrutinised as part of the work that we do as part of our review.
I have one more question if no one needs the microphone. It's a slightly specific one on Heartland Bank. They're sort of one of the few banks that are sort of they reported a large impairment. I think on your dashboard they even reported it as having a negative return on capital. A lot of that is to do with the fact that they were carrying these loans for a very long time before impairing them, and when they did write down those loans, investors seemed surprised by that, and the share price fell. They weren't necessarily the most clearly reported, you might say. Is that behaviour that the Reserve Bank might be worried about, and is it watching for that in the larger banks where that might actually pose a financial stability risk? This idea that people are carrying loans that are essentially non-performing or even delinquent, you might say, but not yet reporting them as that, keeping them in sort of a category of arrears rather than delinquent and writing them down.
So, as always, we can't comment on individual banks, and I note that you've made the question broader in terms of the approach. The provisioning is an obligation of the institution. I know that boards put a lot of effort into assessing those numbers and having confidence when they publish those numbers. They're part of their key financial statements, so that's part of the process for a listed company. We engage through our prudential supervisory interactions with all of these institutions, engage with those boards, discuss the economic outlook, what it means for them, what they're thinking about it, so that they know that we are closely watching and monitoring and engaging with them as they manage their way through the economic cycle. Great. So no more questions from the floor. So it's a short and sweet press conference for our financial stability report. Thank you for joining. Please use the free time, the gift of time, to get into the report in more detail. There is a lot of material there. We're very proud of a number of the special topics and boxes in there, which we think have a lot of rich insight in them. Thanks for joining. We'll see you again in a couple of weeks for the monetary policy statement. Ngā mihi kia koutou.